Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, February 8th, 2022. It is 2:17 p.m. Eastern Time as I'm starting the video. And I'm going to cover a few different things. We'll do a very quick update on the broad markets. I want to do an update on gold, silver, the dollar, and the euro as well, and maybe that trade idea I threw out to you, that individual stock RKLB, quick update there. And then finally, something that I think will, a couple charts to keep an eye on that will help determine just how fast and how much and how long Powell's going to have to raise rates for, because that's $1 million question right now. Is we know rate hikes are coming, and obviously the more aggressive those hikes are, the bigger impact it's likely to have on the economy and the stock market. Vice versa, it goes the other way too. And so I'll get to some things to watch there. All in all, it won't be that long of a video. We're just talking probably less than a dozen charts. Let's start out here with QQQ. This is a daily chart. What stands out to me, I think the levels to watch. We've had some consolidation over about the last four, the last four trading sessions right here. So watch to see which way this breaks. Whether it breaks it up or down the near term, nothing's going to change on my intermediate and longer term view. Remember, I'll always give you the short-term charge, short-term analysis, my thoughts, especially if there's any active trading opportunities. But for the most part, I'm in swing and even trend trading mode right now with the indexes, believing that there's more downside, and so I'll continue to speak to those positions for longer term traders and swing traders that aren't trying to game all the little zigs and zags in between. So I still think we're going to hit those, and I'll revisit those targets in a second. But for near term, watch that. That's a daily chart. You can see those candles just nice and tight next to each other. You can also zoom down to a 60-minute chart, and it's here. I can show you a different variation. We'll look at this one's fine. That was that last nice shorting up at the fibs there. And then we came in and we back tested the top of this recent consolidation range. And so with that being said, my longer term outlook, plus the fact that we've already had the typical retracement again, a week or so ago, I did a deep dive into the previous comparable corrections over the last few years. And this one, it went right up to about where they went in both price, percentage retracement and fib retracement. So with that being said, that puts me to lean towards that we'll get a downside break there. And again, that's something to watch for. Again, that consolidation right here really over the last few days here. You can see it here on the 60-minute chart right there. So look for a breakdown below. It should spark the next wave of selling, but we'll see. You got to be patient when you're playing the long game. No, I'm not talking about being position long, being position short, but trading the longer term trend. These things sometimes take a while. And especially considering that the markets just had their worst start to a year, the worst January since the Great Recession, since back in 2009 during the financial crisis. So it's a 18% drop so far in QQQ, and that's just a, again, run-of-the-mill counter trend bounce at this point in time. Okay, and in one of the recent posts, I wanted to share this one. Somebody asked if I could post a QQQ chart with the levels, and including the T1 through T5 targets. Well, my answer was I posted several. I did have a total of 5 targets on the 60-minute chart when we started shorting back a couple months ago. And all 5 of those targets were hit. And then early on, as we were approaching, or I don't know if it was just before, just after the first couple targets were hit, I started focusing, really expanding, add additional targets, and I did so by using the longer term charts, including the weekly. So that's what I posted here. This was the last one that I posted in a static chart, and they asked me to post that chart because of the fact that it can be hard to sometimes see in videos. And I always have to repeat this. I try to get these videos, especially if there's time-sensitive trade ideas or actionable ideas in there. I get them out to you. I've been in more recently trying to fire them off right after they've been uploaded to YouTube. Now, once they get on the YouTube servers, they continue to process or render that video, so it's initially available in low definition, not HD. And then after about, depending on the length of the video and I guess how busy their servers are, usually within 10 minutes or so, it's available in HD quality. So I would encourage you to take a look at it. And it's going to be in the bottom right hand corner, and there's that little gear icon. Hit that. It should be, if you put on auto, it should tell you if you're in 720p HD high definition. And if not, you can try to select that. If it's not available, it just means they haven't finished rendering the video. And the 720 PhD on charts is going to be fine. I've looked at both. There's no reason to do the 1080. It's just going to cause a lot longer upload time to the video, and therefore I can't get these things out to you guys as quick. So there's really, again, when you're looking at charts, you're not looking at a a movie and it needs to be in 4K or anything like that. The 720p is usually more than sufficient. It's also check your device, your monitor. If you're watching your cell phone, I don't know what to tell you because it's really not going to make much of a difference on 720 and 1080. All right, anywho, this is the chart. So the last time I posted on the site the weekly chart with those targets, and I wanted to share it, was back here. They're always time stamped, January 24th. So, and that was right when I hit. I wanted to let everyone know at the time that the weekly target on QQQ T1 was just hit for an approximately 16% gain. Again, we had multiple short entries here, all of these up in here. So even though it was an 18% drop, on average we were shorting all the way right off the highs and just below, and so it was roughly, again, 16% depending on where you shorted. And you can see that candle. I think you can see it there, right there. I got to pull back out. We're right on it. And so here's the overhead resistance levels. It's that big, that level right there. The recent consolidation, as well as some of the moving averages, like the 200-day moving average. And so I had us bouncing, my preferred scenario, bouncing back up. That's certainly a possibility and still is, but I don't think we're going to get there based again on what happened on the 60-minute chart. So all this stuff kind of comes together, and I think you're starting to piece that together. That's why I look at 60-minute charts, daily charts. We look at the fibs. And, at this point in time, I figured we'd come up to about this level right here and take the next leg down. And that's where I think we are. So again, that was, you can see that post in the, it's in the comment section for the second to last, or now third to last post that I've made. And this is the updated chart. Same thing, weekly chart. I'm just tightening it up a little bit here. You can see that I have, when I move it around, these things get moved. This says potential T4 down here. T3, T2, same targets I had there, and we bounced about where I figured we'd bounce. That was right here is when we hit, and we bounced right up there. There's the 200 daily exponential moving average. It's the same as this chart here. It's a 40-week moving average, and then after that chart, a couple weeks ago, I put on this 40-week simple moving average because some traders watch those. That's the same as the 200-day on the daily chart, and that is where we bounced to. We hit that 200-day so far, and it was we went a little bit lower after T1 was hit there, and then we did that 61.8 retracement in QQQ and the 50% 61.8 in S&P 500, 50% on QQQ, and that so far was the stopping point. So if things play out the way I think they do, this is what happens from here. And then again, very near term, I showed you that little consolidation area. We need to punch down through and of course take out the recent lows, and that should open the door for my second target. These are unadjusted targets, meaning they're the actual resistance level. Ideally you want to cover a little bit above that. Although it's not unusual when you have a, if we're coming in at T2 like we came into T1, meaning coming in hot, meaning, pretty impulsive move down, then you tend to overshoot. You have a momentum-fueled overshoot. But to be safe, target supports roughly 299.15, and on a weekly chart, you can't zero into the penny close enough, call it 300. You might want to cover a little bit above that because you're likely to get a reaction there, unless, again, you're playing the very long game and you're going to hold out, which I think we'll hit. Because, again, I've said this multiple times, if we get there to my second target, now you're talking a drop off the highs of, instead of 18%, you're talking a 26%. They're going to be all over the papers. We're in a bear market. Fed's hiking, blah, blah, blah. And then you're going to see more and more stops hit, people taking profits. panic selling, short sellers piling in, and that's just what it's gonna do is serve to roll over some of my longer term trend indicators that have yet to roll over. So I think if T2 is hit, it's also going to increase the odds of T3 and T4. I mean, that sounds logical, doesn't it? Obviously, but for that technical reason, not just because you're getting closer. T3, 268, and or the trend line. I have alternate trend lines here. They're all coming in together. So at the end of the day, I think we'll hit those long-term trend lines. I think this potential T4 is likely coming to play. So this is probably where we're going before all said and done, before we get some significant reaction that can last for weeks or even months, a big bounce. So we're talking probably about 40, from the highs, roughly 40% drop, correction, bear market, and call it what you want. All right, those are my targets, and let's look at a few other things. Oh, and before I leave that post, one other question I had in there. Somebody asked if I could explain a bull or bear flag and how long it could stay in place and all that. My answer, I'd encourage you to read it, but basically I said, from my experience, you're going to get a different answer when you Google it. But number one, I did recommend do a quick Google search. You're going to see a lot of explanations and examples. But from my experience, they can form on any time frame. I've traded them on 5-minute time frames all the way out to weekly time frames. So basically, the longer the term time frame, the longer it's going to take to play out. A 60-minute bear flag might form over a few days, where a flag on a weekly chart would form over several weeks. But there's 3 basic components. And they're all down here. And again, you can Google that anytime. Let me just do that for you real quick, show you. So if you Google bull flag, and a bull and a bear flag, they're just inverse. One's going up, one's going down. Just click on that. You're going to have a ton of images. You're going to see what they look like, and that's basically it. And again, they'll give you explanations, and everyone's going to give you, well, not all of them, but some people say they must be on this time frame and that time frame, the other. But there's those. I listed what are I believe the key critical components, as well as the measured targets. And we're going to get to bull flag here in just 1 second on a new security. So it's kind of timely that question was asked today. Okay, and before I get away from the stock market, final thing is, big $1 million question is how much we're going to see in rate hikes, how fast, how far, and I'll tell you, it's going to depend largely on a few things, and you can do this yourself. Go to Fred, fred.stlouisfed.org. And that's the St. Louis Fed website. They've got a lot of economic data. You can get these anywhere. Just do a Google search on Case-Shiller home price index. You've got the national home price index. You've got by different cities. Okay, so housing is by far one of the biggest inputs to the CPI, consumer price index. So then when we talk about inflation, that's what we're talking about, and that's going to have a big impact. House prices, rentals, things like that. And so as long as this is going like that and not going like that, he's going to have to stop tapping. Let me back up. He hasn't even tapped on the brakes. All he's doing right now, all he's done is talk about raising. All he's done is manage to pull a 180 from his uber dovish stance just, 4 months ago. Inflation's transitory, that whole bunch of malarkey or whatever. He was just wrong. Let's just leave it at that. But all right, so now he's acknowledged that inflation is, a risk to the economy. So he's talking about raising rates, and probably will almost certainly raise rates starting next month. But how much and how fast will be, I think, to a large extent determined by this. Because if we continue to see housing prices and the other components, which I'm about to get to in a second, gasoline, energy, oil prices, and food prices. Food is another big one. And those are the 3 big ones: housing, energy, and food. Okay, so we're going to watch those. This is easy way to track housing. It's going to be a little bit lagged. You can get on your Zillow account. And you can even pull some trends there, shorter term stuff. But you can see this is what happened. There was the housing crisis. They called it the financial crisis in '08, but it was almost solely contributed to the bubble in the housing market because of the banks, taking losses. They were giving out liar loans, and people were walking away on their mortgages, and so that triggered the recessions. Are those shaded gray areas right there? I think you can see that in the video. I zoomed in. I'll zoom in more. So we're going to watch this, right? That makes sense. We're also going to watch, you can simply do USO for crude oil. That's what USO looks like. I made a comment on this as well today in one of the sections. We already broke the primary uptrend line. We've been back testing with a minor trend line. Big resistance there. There was a huge gap, super technically significant back here when COVID first hit. We're in that gap now, and it's only a matter of time if the stock market continues lower that crude will as well. The technicals are priced in. So, but however, as of now, it has not abated, and it's going to take a pretty, decent move down in crude to help alleviate some of the inflationary pressures. This has been climbing strong, and again, coming up to major resistance. So I think there's the upside is limited on crude at this point, but it is a big factor. And again, something we watch, because if we start seeing a pretty sharp abatement in all of this stuff. But here's the thing, guys, it's a double-edged sword. Crude, yeah, that helps, okay? The only people that don't want to see crude prices fall are oil companies, okay? Everyone else, airlines and consumer, we drive cars, boats, everyone else wants to see it. But the housing market, unfortunately, that's a double-edged sword, because if that pulls back, that is the one of the two big pillars of a consumer's wealth: the stock market, their 401k, and the housing market. So it's going to actually dampen the wealth effect. But again, you've got to see these prices come back down to earth. There's all these reports coming out now that, I just saw one the other day. The average, someone well-to-do, middle class, making, I think it was 70, 100,000 a year. That person's now priced out of the housing market. And there was again, I don't cite all the details of the study. The other thing we're going to watch are commodities, because remember, crude oil, obviously, and energy is a big one. For commodities, there's several you can watch. What you want to just look at, keep it simple, is a broad-based commodity ETF that's going to include everything. This is one that I've been tracking for a while. I've shared it with you in the past. DJP, which is the Dow Jones UBS Commodity Index Total Return ETN. And you can't see it on the video, I know that, but here's the weightings. It has gold, crude oil, natural gas, Brent crude, corn, soybeans, copper, aluminum, silver, live cattle. That's a well-diversified commodity ETF. And so this is what is a thorn in Powell's side. This is what Powell grossly underestimated. Just because that happened in 2008, that they threw a ton of money in the markets and quantitative easing, he suffered from what's known as recency bias. There were a lot that's saying this is going to be inflationary sooner or later. You keep pumping tons of cash, printing money, injecting into the economy, creating money out of thin air, it's eventually going to lead to inflationary forces. So they tried to blame it on COVID, but again, I've gone over that, and you can read up and look into it. It is more of a demand problem than a supply problem. I'm a firm believer in that. Again, you can differ with my opinion, but the bottom line is we have inflation. And so here's what has to happen. And I think you get it. Here's a little trend line here. We're going to break it. We're going to get an abatement, but we're not going to go back. So you look where DJP is at. DJP, again, a broad-based commodity index tracking, that commodity index this is where we were before COVID hit. So this is what Powell did. The pooch, he let the cat's out of the bag. Inflation has finally reared its ugly head, and it's here to stay. And if you see a complete abatement of all those post-COVID drops, you start seeing crude coming down and DJP. And another one to look at that I like as well is GCG. Nope, let me grab it over here. It's on GCC. Wisdom Tree Continuous Commodity Index Fund. Again, you can see where commodities were in a bear market for a long time. COVID hit, and that just ended the bear market. We are now in what appears by all metrics that I track on the charts, it appears to be early stage bull market price action going on right now. So that's where we're at, and these are the things to watch. This one has about a quarter of its holdings in soft commodities, a quarter in, the grains are soft. There's all kinds of stuff in there. Precious metals, energy, livestock, the breakdowns over here. And so again, does this stop? If it continues, you're going to see aggressive hikes. You're going to see maybe a 50 basis point at one of the upcoming meetings. You could even see an intermeeting emergency rate hike. Those always rattle the market. But if we start to see things abate, maybe it'll be a gentle climb. Again, I don't know. The point is, I'm going to take what happens. I'm going to watch the housing market. I'm going to watch agricultural commodities, industrial metals, and energy, and factor that in to my longer term analysis. But ultimately, the charts will always be my guide in the near term. But it helps to factor in fundamentals. So I just want to share that with you guys. Those are things that you can track on your own. And of course, trade as well. You can trade these commodities, which we do. I'm actively posting commodity trade ideas. Okay, quick update on this RKLB, Rocket Labs, trade idea throughout today. Came public back here in late 2020. Has a very well with support there, recently broken. And what I like about it, I love to see things like this because that would be a false breakdown, aka bear trap. And we did recover it today. We popped slight above it. I have to be honest. I wish there was more follow through. I told you 987 I thought would do the trick, and we did. We took it out intraday. We're still above it. We're at 991. But I'd like to see, and it will really help to see a solid daily close. That's why I said you could either take it on the downtrend line breakout, which is why I posted it, and or means, what does and or mean? Well, and means you take a partial position on the breakout of the trend line, and then you add on a break above 987 if you want to wait for a daily close. Or means you might want to hold off and not jump the gun in case it gets rejected at the trend line. The or means you wait for a breakout above that. And being a daily chart, you're going to have increased the odds if you wait for a solid close. But if it starts to run by the time you get a solid close, let's say it's tomorrow or next day, it could be way up there. So anyway, I like it because I think it has the potential for a nice short squeeze. And I gave you my targets there. And might even run up to that previous high there if we can get some traction. Because you can see the nature of this beast. It has these downtrend lines, right? Like this, 1, 2, 3. And when it pops them, it runs. Pop this one, came in and back tested it right there at that level, and then it ran about 117%. Broke this trend line, it ran about 33%. And this is a bigger trend line, so I don't see any reason. And coupled with the false breakdown, I don't see any reason why I couldn't run up and hit those levels there. So I might make this more of a target zone. Maybe I'll post an update on the site. Yeah, I call that about 1190 to 1235, more of a T1 target zone there. And if you really want to sharpen your pencil, you could say there is some resistance about 14. So those are some additional targets. That's why I wanted to update that. And then again, you had that 60-minute divergent low. Took out the trend line, trying to break this resistance level there. All right, last but not least, let's talk about the euro and the dollar. So we had some interesting stuff lately go on in the euro. It's been in a downtrend for a while. I mean, the dollar's been rising because ECB has been, as tough as Powell is, he's actually the most bullish guy in the room lately. But the euro's had some pressure because the Bank of England's all of a sudden getting aggressive with back-to-back rate hikes. And so I think, as I said last week, you're going to see a game of catch-up, and that's being played here. So the bigger picture was this. I talked about this downtrend line and this triangle pattern. It broke down. You had that impulsive drop because the triangle, well-defined, broke, right? But then, if you weren't paying attention, at the same time, that big breakdown put in this big, powerful divergent low right there, and it's been impulsive buying, and then we went on to break out the trend line, right? And now let's turn off all the lines. Remember I was talking about bull and bear flags earlier? Well, guess what? That's what that is. At least it has that appearance. The flagpole consists of first a bull flag pattern consists of an impulsive move up called the flagpole, followed by a level of consolidation that takes the form of a flag or a pennant. And then if it breaks out to the upside, that would be your buy signal or buy trigger. And the measured target, now that it's guaranteed to be hit, but that's what it is. You take the flagpole, add it to the lowest point of the flag before it breaks out. And so that'd be a pretty powerful move. It would take the euro up, probably to that 1117 resistance level right there. I'll call it a zone. Let me give you one more level. Okay, I don't often trade the currencies. I'm not a big Forex trader, but I do like my gold and silver, and so I use that to align. When the euro rises, that means the dollar is falling, and that's bullish for gold and silver. And I'm still watching this big symmetrical triangle. So that point is what I'm trying to get at. That bull flag in the euro, and coupled with the recent false breakdown, aka bear trap in the euro, would aligns with the fact I talked about how symmetrical triangles, they usually break out around 80%, 70-80% of towards the apex of the wedge. Right there. There is the wedge of your triangle. So this thing's ripe to break out if it's going to. And it could break to the downside too. But if that Euro bull flag does play out and hits its measured target, that will almost certainly be the catalyst for the breakout of gold in a pretty impulsive leg up. So watch for that. They are both trade setups. That bull flag or potential bull flag in the Euro has not broken out, nor has this symmetrical triangle in gold. I think there's a good chance they will. Positioned ahead of that, and I'll add to it only if and when both of those break out, and assuming those breakouts hold. If they fail, then that's another story. We'll revisit it at the time. Silver looking good too. There's your downtrend line. There's your positive divergences here on that low, that lower low right there. There's your positive divergence line, and that would be ultimately, I view this as a bull market consolidation, and we could get another major leg up in silver. I think that's it. Yep, that's all I wanted to cover. Let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.